All right, a quick update on something outside the stock market. On Capitol Hill today, the House Financial Services Committee held a hearing on financial regulatory reform. We've got CNBC's ace Washington reporter Hampton Pearson with us. Hampton, did anything come out of this? I heard them arguing with each other, basically.
Well, you know, for all the high-minded rhetoric about the need for financial reform after the greatest financial crisis since the Great Depression, what we got today, Larry, was raw wounds and a good old-fashioned Washington turf war exposed, something, you know, Washington really understands. You've got the Treasury Secretary, Tim Geithner, drawing his lines in the sand, basically saying, among other things, the Fed should be the uber regulator as far as systemic risk, and you've got to have a brand-new Consumer Financial Protection Agency to clean up the act in that sphere. Then you have Fed Chairman Bernanke and, to some degree, FDIC boss Sheila Bair pushing back on the powers of that Consumer Financial Protection Agency. And, of course, we have Sheila Bair at odds with Fed Chairman Bernanke over the whole notion of how do you manage systemic risk. Bair and SEC boss Mary Shapiro are very strongly in favor of, quote, a systemic risk council with teeth, as opposed to the Fed taking the lead. All that got exposed today.
I can't really try and figure out if any of this has any market impact at all, and I've concluded it doesn't. But one thing I want to ask you, President Obama at his news conference the other night, for the first time kind of unveiled this idea of financial penalties for banks who take, quote-unquote, excessive risk. Now, that could have some impact on banks. Did that come up today?
Well, it was buried in the prepared testimony, both, I believe, in the FDIC remarks and, to some degree, the Fed remarks as well, that if they recast the whole notion of how do you deal with, quote, too big to fail, they want to build in some sort of penalty and or upfront fee structure to cushion the potential cost to taxpayers.
I thought the biggest thing I heard reading the press reports was Ben Bernanke telling people, I guess he must have responded to a question, that his emergency liquidity programs are running out, nobody wants them. Now that is significant and, in my opinion, very bullish.
No, absolutely. You're right about that. That was part of, let's say, a good news story we were trying to get from both the Fed and the administration this week. Also, them on the same page that something like $70 or $80 billion in TARP and or emergency funds have, in fact, being repaid. And, you know, we all had the story earlier in the week that when Goldman, for instance, paid back its government money, you know, you had the Treasury Secretary and others saying, oh, by the way, taxpayers made 23% on that particular investment.
All right, Hampton Pearson, thank you very much. We appreciate it. Have a great weekend.
Likewise.
Let's go back to our Uber panel, and let's bring in contributor and syndicated columnist Jerry Bowyer.
Hey, Larry.
We still have Steve Moore, who decimated the family jewels by selling his entire stock portfolio today. We have Joe Battipaglia, Peter Marisi, and Bob Froelich as well. Jerry Bowyer, get you involved. Does this regulatory stuff mean anything? I mean, the way I look at it, this could be Sarbanes-Oxley redux.
Yeah, it could be. So it's really destructive, which means it's really great that for now there's this great food fight, you know, where these bureaucrats are fighting one another. I think that's wonderful. When the president proposed this idea of an Uber regulator, it's like this jump ball. And then whoever is most ambitious, they're throwing elbows at one another and headbutts. And Sheila Bair's in there, and Ben Bernanke and Tim Geithner. I think it's wonderful. You remember James Stockdale in the 1992 election when he kept saying gridlock? Gridlock.
Gridlock. Gridlock. That's the watchword today. Gridlock.
That's right.
We got the most bullish thing. I'm trying to persuade Steve Moore
right now.
Gridlock is like totally bullish. I can't even get a smile. There he is. He nodded to me.
What did he buy? We heard what he sold, but what did he buy?
I don't think he bought anything. I think he just went into cash.
It's under the mattress.
I want to get Bob Froelich's investment strategy. Bob, you've been on the bull camp, and you're having a good year on this thing. What are you saying now? What are the best places to go? Because I maintain that it's not too late to get into this, that we are going to 1,100. I know I'm a bull, and I know that Joe and others disagree, but if you buy the bullish case and the summer rally continues with its various pullbacks and corrections, where do you invest, Mr. Froelich?
Well, first of all, I just bought Steve Moore's portfolio at the break, so I'm really happy. let me tell you, big picture, I like two sectors, Larry. I like financials and I like industrials. I think that's going to lead this rally because I do believe we're going to see the economy finally come along in the second half of the year. And financials, you know, basically they can access capital, access money for free. That's a great, great model, and I think they're going to continue to surprise. And what I really like about the industrials is I would be positioning portfolios really looking at the conglomerates, looking at machinery, those companies or those subsectors that drive a lot of revenue outside the United States, because that story is starting to improve as well. German business confidence has turned around. Japanese exports are up. You know, in India, we had more infrastructure spending this past month than any time in the last 18 months. So I think there's some mustard seeds, if you will, outside the United States.
All right, Steve Moore, he's trying to make a buck for you so you can redeem yourself. He says financials and industrials. I want to really echo the financials thing. I mean, I say find a bank you hate and buy it. Even a banker can make money at a zero interest rate at the bottom and lend it longer, and steep upward yield curve, Steve.
Well, first of all, Larry, let me just tell everybody there that I'm going to sleep like a baby tonight, and it's not because I'm crying. And, you know, to my friend Jerry Bowyer, who I just love and adore, I mean, Jerry, you and I have been brothers in arms on this. Where's the growth going to come from? I mean, we got cap and trade. We got socialized health care coming. We have rising interest rates. We have a $2 trillion budget deficit.
Yes.
Larry, you talk about, you know, free market capitalism.
Gridlock.
We don't have it anymore. It's gone.
No, gridlock. I have a new phrase. I have free market gridlock.
All right.
Peter
let me respond.
Hang on, Jerry. Wait. Peter Morisi is dying to jump in. He's jumping up and down in his chair, and I want to give him his whack. Peter Morisi, I'm kind of into free market gridlock right now.
I'm not. My feeling is consumers will start to come back in the fourth quarter, but more importantly, a lot of American companies have so cut their costs that they can make money and profits will rise even with moderate growth. Moreover, a lot of our companies like Caterpillar, GE, and so forth are poised to take advantage of a lot of market growth in China and India, and those markets are taking off. Profits may be down 22% from last year, but stocks are down 36% from their peak. That gives me 14% more to run. I see the S&P at 1130 to 1150 by the end of the year. 1130
to 1150 by year end. That's a great bold prediction. I just want to run down real quick as we run out in this segment. You guys are going to hang with us. Intel, Cat, Apple, Starbucks, Merck, and Pfizer, okay? eBay, AT&T, 3M, Bristol-Myers, Ford, Union Pacific. Now, the point I'm making, Peter, in support of your contention, is that these improved profit earnings are coming from all corners of the economy. It's not just one little niche. It's broad-based. And on top of that, I got to throw in the banks because I think Brother Froelich is exactly right. I mean, I think you got it nailed. Bob Froelich, what's your year end? We just heard, what did you say, Peter? You were over 1,100 by year end?
1130 to 1150 on the S&P.
All right, the S&P closed at close to 980 today. Bob Froelich, what's your call on that?
Yeah, we're 1175 on the S&P, and I think the Dow will be above 10,000.
All right, good stuff. We're going to come back. We're going to say goodbye to Dr. Bob Froelich. We're going to get Joe Battaglia back in the flow, Jerry Bowyer, and we're going to try to rescue Steve Moore's whole portfolio story. Coming up next, much more stocks. Still plenty of time to ride this rally. That's the key thing, folks. If you're looking at 1,100 or 1,200, and I don't know when, maybe it's going to be 2010, maybe it's not till 2011. That means for those of you that are still on the fence, maybe sitting in cash, you can understand risk is improving, the economy is turning into recovery. There's plenty of time to get in. There are going to be corrections and pullbacks along the way, but there's plenty of time to get in. I'm Kudlow. This is the Kudlow Report. We'll be right back.